December just became the most important month for AI investors, and I'm about to show you 7 companies that could absolutely explode heading into 2025. But here's what Wall Street isn't telling you. These aren't the AI names you're thinking of. While everyone's chasing the same overcrowded trades, I've identified companies with $140 billion in locked-in contracts that haven't even started generating revenue yet. Stay with me because by the end of this video, you'll understand why timing this Santa Claus rally could be the difference between 10% gains and life-changing returns. Let me hit you with something interesting. Going back almost a century, the S&P 500 finishes December green about 75% of the time. The Santa Claus rally, those last 5 trading days of the year, has been positive roughly 80% of the time. Now, I'm not one to bet the farm on seasonal patterns, but when history is this consistent, I'm paying attention. But here's my twist. I'm not spreading this opportunity across the entire market. I'm laser-focused on where the real infrastructure money is flowing right now. Here's what's happening that most investors are completely missing. Tech giants are in an arms race to build AI infrastructure, and they need 3 critical things: massive computing power, networking to connect it all, and reliable energy to run it 24/7. We're talking about data centers that consume as much power as small cities. Microsoft just got a $1 billion federal loan to restart 3 Mile Island's nuclear reactor exclusively to power their data centers. Let that sink in. The U.S. government is financing nuclear restarts for AI infrastructure. This isn't hype. This is contracted, committed capital flowing into picks and shovels plays that most people don't even know exist yet. And the best part? Many of these companies have multi-year revenue already locked in before their infrastructure is even fully operational. Today, I'm breaking down 7 companies positioned at the center of this build-out, using my systematic scoring model to separate the real opportunities from the noise. Before we dive into the names, let me show you how I'm evaluating these opportunities, because throwing darts at AI stocks is how you lose money. I use a 4-factor scoring system that keeps me honest and cuts through all the hype. First, valuation. I'm looking at PEG ratios, price to sales, and free cash flow yield. Growth is great, but not if you're paying 50 times sales for it. Second, financial strength. Revenue growth, margins, and balance sheet health. Can this company survive if the market turns? Third, technical momentum, because timing matters just as much as picking the right stock. I want to see buyers in control, not a falling knife. Fourth, trend direction, using ADX and rate of change indicators to confirm we're not stepping into traffic. I'm not throwing all these metrics at every company. I'm pulling the signals that actually matter most for each specific situation. This is my filter. Now let's get into the names. Number 1, Nebius Group, the AI infrastructure company you've never heard of. Nebius is building GPU as a service infrastructure for AI training and inference. Think of them as the foundation layer where companies need massive compute power but don't want to build their own data centers. Here's where it gets interesting. They've secured $20 billion in long-term contracts. Let me repeat that, $20 billion. That includes a $17.4 billion 5-year deal with Microsoft and roughly $3 billion with Meta. These are multi-billion-dollar agreements locked in before the infrastructure is even fully deployed. Now, the trade-off: Nebius is burning cash today to build capacity that's already contracted for tomorrow. They're deeply unprofitable right now as they build out data centers across Europe and the US. But here's the kicker: they've got billions in contracted revenue waiting once facilities go live. The validation moment? NVIDIA invested in them in December 2024, taking a 0.5% stake. When Jensen Huang writes a check, I pay attention. Management projects an annualized revenue run rate of $7 to $9 billion by the end of 2026. If they execute on that build-out, the contracted revenue provides a clear path to profitability. My take: this is a pure infrastructure play. Negative cash flow today, but with revenue visibility that most capital-intensive companies never get. The technical momentum is strong despite the cash burn. Analysts are projecting 101% upside over the next 12 months. This is a higher risk, higher reward play for investors who can stomach volatility. Number 2, Cameco, and this might be the most misunderstood opportunity on this entire list. Cameco is one of the world's largest uranium producers, and uranium is the fuel for nuclear reactors. That simple fact matters more now than it has in decades. Here's the problem tech companies are facing. AI data centers need massive amounts of reliable, carbon-free power. Solar and wind can't provide the baseload power these facilities require. Nuclear can. Just days ago, the Trump administration closed a $1 billion federal loan to restart Three Mile Island's nuclear reactor, exclusively to power Microsoft's data centers. Let me emphasize this. The U.S. government is directly financing nuclear restarts for AI infrastructure. Back in October, Cameco, alongside Brookfield Asset Management, entered an $80 billion strategic partnership with the U.S. government to accelerate deployment of Westinghouse nuclear reactors. Cameco owns 49% of Westinghouse. The current administration aims to quadruple nuclear energy output over the next 25 years. And here's the critical point. The uranium market was undersupplied before AI demand even showed up. Now the supply-demand imbalance is intensifying. Google, Amazon, and Meta are all signing nuclear power deals right now. Cameco controls critical uranium supply at exactly the moment the nuclear renaissance is shifting from theory to reality. My take: this is an infrastructure bet on the energy side of the AI equation. While everyone's focused on chips and servers, the power question is becoming critical. Analysts give Cameco 33% upside over the next 12 months, but I think that's conservative if the nuclear build-out accelerates. Before we continue, let me introduce today's sponsor, 21 Shares, one of the world's leading crypto exchange-traded product providers. Look, I've followed crypto markets for years, and I've seen many investors hedge against dollar erosion with small crypto allocations in their portfolios. What I appreciate about 21 Shares is they're bridging the gap between traditional finance and crypto. They offer fully collateralized and registered investment products traded on global exchanges, including products that track major digital assets like Bitcoin and Ethereum. They maintain a deep focus on transparency, compliance, and investor education. You can check their website for fact sheets or their insights section to learn more. And if you want to stay ahead on crypto trends, subscribe to the 21 Shares newsletter for market insights and breakdowns. Link is in the description. As always, this is not financial advice, and all investments carry risk. Now, back to our AI infrastructure plays. Number 3, AppLovin, the money printing machine hiding in plain sight. AppLovin has become one of the most dominant forces in mobile advertising by building AI that essentially prints money. While most investors know them for mobile gaming ads, what's happening behind the scenes is transformative. AppLovin's Axon 2.0 engine predicts with stunning accuracy which users will download apps and engage with them. When Apple's privacy changes crushed most ad platforms, AppLovin rebuilt their entire system around machine learning models that didn't rely on tracking individual users. The result? Complete market dominance. In Q3, here are the numbers. $1.4 billion in revenue, up 68% year over year. Adjusted EBITDA hit $1.16 billion with an 82% margin. They're printing $1 billion in free cash flow every quarter, up 92% year over year. Net income reached $836 million. Let those numbers sink in. 82% EBITDA margins. That's absolutely insane for an ad tech company. The catalysts. They got added to the S&P 500 in September, which triggered massive institutional buying. They've authorized an additional $3.2 billion in share buybacks and are aggressively retiring shares with that free cash flow. In October, they launched their self-service advertising platform, taking that same AI technology beyond mobile gaming into broader e-commerce. Early advertiser spend is growing 50% week over week. The risk? They're in a lawsuit over data collection practices. That could be bumpy over the next year. Either they lose and the stock takes a hit, or they win and the stock gets an extra boost. For me, I'm letting it ride to see if there's any real impact. Analysts give AppLovin 50% upside over the next 12 months. Based on my scoring system, this one ranks at the very top of my list. Number 4, ARM Holdings, the royalty business at the backbone of modern computing. Here's what makes ARM fascinating. They don't make chips. They license the architecture that powers them. Every iPhone, most Android devices, and increasingly data center servers run on ARM-based processors. It's a royalty business model on the backbone of computing. They get paid twice, once when someone licenses their design, and again as a royalty every time a chip using that architecture ships. Recent Q2 numbers. Revenue hit $1.14 billion, up 34% year-over-year, third consecutive quarter above $1 billion. Royalty revenue reached $620 million, up 21%. Data center royalties doubled year-over-year. Here's why this matters. The data center transformation is accelerating, and ARM-based server chips deliver dramatically better power efficiency than traditional x86 processors. Google's ARM-based Axion chip delivers 65% better price performance while using 60% less energy. When you're running massive data centers, that efficiency translates to hundreds of millions in savings. Amazon Web Services, Microsoft, Google, and NVIDIA are all developing ARM-based chips for data centers. Microsoft expanded ARM-powered Cobalt 100 to 32 regions globally. NVIDIA secured over $500 billion in expected orders through 2026 for ARM-based Grace Blackwell superchips. The cherry on top, ARM is a strategic partner on the Stargate project, a $100 billion AI infrastructure initiative alongside Microsoft, NVIDIA, and OpenAI. My take. ARM is positioned at the intersection of mobile dominance and data center transformation. This is a high-quality business with improving economics as data center mix increases. Analysts give ARM 44% upside over the next 12 months. Number 5. Applied Digital, the higher-risk mirror of Nebius Group. Applied Digital is also building GPU-as-a-service infrastructure for AI training and inference. When companies need massive compute power but don't want to construct their own data centers, Applied Digital builds the facilities and leases them the capacity. The contracted revenue, approximately $16 billion in long-term contracts. That includes an $11 billion deal with CoreWeave for 400 megawatts and a $5 billion 15-year agreement with an unnamed U.S. hyperscaler for 200 megawatts. Again, multi-billion-dollar agreements locked in before infrastructure is even fully built. The challenge: Applied Digital is burning cash today to build capacity that's already contracted for tomorrow. They're deeply unprofitable as they construct data centers across North Dakota. The validation: NVIDIA invested in them in September 2024. An asset management company committed up to $5 billion in project financing to fund the build-out. Management expects their first 100 megawatts of the Ellendale Forge 1 campus to come fully online any day now, with full 600 megawatt capacity across both campuses operational by 2027. My take: this is a pure infrastructure story. Negative cash flow right now, but with revenue visibility that most CapEx-heavy plays never get. They have strong momentum securing big hyperscale customers before competitors can deliver capacity at scale. The risk here is execution. Can they actually build out what they've promised on time and on budget? Analysts give Applied Digital 117% upside over the next 12 months, the highest on this list. That upside comes with proportional risk. Number 6. Arista Networks, the networking backbone that makes AI data centers actually work. When Microsoft, Meta, and Google build massive AI infrastructure to train models like GPT or Llama, they need networking equipment that can handle insane bandwidth demands, moving data between thousands of GPUs running simultaneously. Arista owns that space. Q3 numbers. Revenue hit $2.3 billion, up 27% year-over-year, their 19th consecutive record quarter. Software-driven approach delivers gross margins above 65%. Compare that to traditional hardware vendors stuck around 20 to 30% margins. The moat. Once a company deploys Arista's platform across their data center, the switching costs are massive. You don't just swap out Arista for a competitor, your entire network architecture is built around their operating system. The company crossed $1 billion in quarterly operating income for the first time. They've expanded partnerships with NVIDIA, AMD, and OpenAI, building products specifically designed for AI workloads. My take: as hyperscalers pour hundreds of billions into data centers, Arista is positioned to capture significant network spending. This is a high-quality business with strong margins, minimal customer concentration risk, and a long growth runway. Analysts give Arista Networks 46% upside over the next 12 months. Number 7. Meta Platforms, yes, Facebook's parent company, and hear me out on this one. Most of you know what Meta does: Facebook, Instagram, WhatsApp. But their latest quarterly earnings got hammered for AI spending, and I think that was a complete overreaction. Here's what's actually happening. Reels now accounts for 50% of all Instagram screen time. Time spent on Facebook increased 5%. Threads jumped 10%. Their AI ad targeting allows advertisers to reach users with precision that TikTok can't match. The value signal. Their PEG ratio is sitting at 0.38. Let me emphasize this. A PEG ratio of 0.38 indicates extreme undervaluation, which is almost unheard of for a megacap this size. With recent pullbacks over the past few weeks, they're sitting in a solid spot for long-term growth. The market is punishing them for investing in AI infrastructure, but that investment is exactly what will maintain their dominance in digital advertising. My take. This is the highest quality business on this list, trading at the most attractive valuation. When a company this profitable with this much free cash flow trades at these multiples, I pay attention. Analysts give Meta 43% upside over the next 12 months. Based on my scoring system, Meta ranks second on my list right behind AppLovin. All right, let me give you my final rankings using my scoring system, looking at valuation, financial quality, technicals, and trend. My top tier, number 1, AppLovin. Best combination of growth, profitability, and momentum. Number 2, Meta Platforms. Exceptional value at current levels. Strong tier. Number 3, Arista Networks. Quality business with consistent execution. Number 4, ARM Holdings. Structural tailwind from data center transition. Number 5, Kamiko. Unique exposure to nuclear renaissance. Higher risk/higher reward. Number 6, Nebius Group. Massive contracted revenue, execution risk. Number 7, Applied Digital. Similar profile to Nebius, slightly higher risk. Here's the thing. Each of these companies sits at a different point on the risk-reward curve. Some are pure growth plays, some are cash machines, some are infrastructure bets that only pay off if AI demand keeps compounding year over year. That's why I use my scorecard. It cuts through the hype and shows what's actually working. Revenue strength, margin quality, cash flow, trend direction, and valuation sanity. If you pick your entry points using technicals, you tilt the odds even further in your favor. For me, there's no reason to guess. You just need a system, and this one puts the math in my favor heading into what could be a very strong December rally. I hope you got value from this breakdown. If you did, smash that like button, subscribe if you haven't already, and drop a comment letting me know which of these 7 stocks you're most interested in. I read every single comment. I'll see you in the next one.